Hey, good morning, options traders, and welcome to our new traders. We've had quite a few sign up this week. It's great having you here. And I received an email from one of our new traders asking, is it possible to ever get a butterfly spread filled for a credit? Now, of course, he's talking about the long butterflies, not the short iron versions, but a long butterfly. And he was just trying to figure out, would it be worthwhile to try to execute these for credits? Well, the answer is they will never fill. And that's because a long butterfly is always going to be a debit. But the more interesting question is why? And if you can understand how to break down a butterfly spread, it will help you to understand potential hedges, rolls, and morphs. So for example, let's look at buying one $100 call, selling two 105 calls, and buying one 110 call. This is a type of butterfly. There's a lot of different ones. I could construct this with calls, with puts. We could mix them. Those would be the iron versions. But just to keep it simple, let's do an all-call butterfly. But your standard butterflies will always be executed in a 1-to-2-to-1 ratio. Technically, 1 to -2 to 1. That just means you're long the first strike, right here long the 100. You're short 2 of the center strikes and long 1 of the higher strikes. If it is a standard butterfly, these strikes will be equally spaced. There are ratios and broken wing versions where that's not true, but again, for this video, I just want to stick to a standard butterfly. So let's say that we get this executed for a net debit of 2. So once again, part of his question was, is it ever possible that this would fill for a credit? So hold that thought and we'll come back to it, but for right now, if we put this trade on in our account for a net debit of 2, this would be the risk graph. So remember, we always get a bend at the strikes. There's our long 100 call. There's our short 2 105 calls. We bend right there at 105. And this bend up here is the long 110 call. So if we executed this for a net debit of 2, then the lowest portion of our graph should be at -2, and right there it is. That's the worst that can happen. So it is a limited loss position. Now we can also figure out the max gain because this happens to be a $5 butterfly. That just means the distance between these strikes is $5. So for those of you who understand the vertical spreads, this is really a 100-105 debit spread on the left, and this is a 105-110 credit spread or a bear spread on the right. So these are just two vertical spreads, 5 points apart, so the most they could be worth is 5. If we paid 2 for it, then the most it could be worth is 3. That would be the maximum profit. And right here, the peak of this blue curve is right there at 3. So back to the question, is it ever possible to get this filled for a credit? Well, just by looking at the risk graph, you can see that if it were filled for a credit, the entire graph would sit above 0. That would be an arbitrage. That would definitely be too good to be true. But let's dig a little deeper. Let's find out why the interplay between these different ratios and different strikes could never be filled for a credit. So here are the 3 positions. Here's our long 100 call, short 2 of the 105s, and long 110. And what you want to do is to break these down into the long positions, the 100 and the 110, compared to the short 2 105s. So let's just say that we have 2 different traders. One person takes the 100 and the 110 call, one of each, and another trader takes these 2 positions here in the center. He's going to take 2 of the 105s. So for this presentation, we're going to assume that he's long these positions. In the butterfly, they're actually short. But let's go and compare them. So there are really 4 different positions that the stock could be in at expiration. It could be below 100. It could fall somewhere between 100 and 105. Could fall between 105 and 110. And it could be above 110. So let's see what's going to happen in these 4 zones. If the stock is anywhere below 100 at expiration, and actually even including 100, the person who has the 100 call and the 110 is worthless. So is the person holding the 2 105s, because all options expired worthless. What happens if the stock gets somewhere between 100 and 105? Well, now the 100 call starts to gain intrinsic value. So let's just pick a number. Let's say the stock is at 105. The long 100 call is worth 5 points of intrinsic. The 110 is out of the money. So at expiration, the person who has the 100-110 pair is worth $5. The trader who has the two 105s is worthless because those are two at-the-money options. So notice with the stock up here at 105, the 100-110 calls actually beat out the two 105s. And that will be true for any number between 100 and 105. If the stock were at 103, the 100 call here would be worth 3. The two 105s would always be worthless. So no matter what price you pick between 100 and 105, the long pairs right here will always outperform. What about if the stock is between 105 and 110, somewhere in here? Well, let's just pick a number. Let's say the stock is at 110. The person with a 2 in green, the 100 and the 110 calls, will be worth 10. And that's because the long 100 call has $10 of intrinsic value. The long 110 is worthless. So it's just worth 10 bucks. What about the person who has the two 105 calls? Well, they now have 5 points of intrinsic value. Right, with a stock at 110, the 105 call has 5 points of intrinsic value, but this trader has done it twice. So 2 times the 5 points is in fact 10. So again, they tie, and that will be true for any stock price between 105 and 110. What if the stock is somewhere above 110, and it doesn't matter, pick a number, but just for the demonstration, let's say it's at 120. Well, now the $100 call has 20 points of intrinsic value, and the 110 call has 10 points. So there's 30 points. So that's going to be 30 points for this trader. And the person who has the two 105 calls, what's he worth? Well, the 105 calls with the stock at 120 are worth 15 points each, times 2 are also 30. So look what's happening. No matter what stock price we pick, compare the 100-110 pair to the two 105s. If the stock is 100 or below, they tie. They're both worthless. If the stock is somewhere between 100 and 105, the 100-110 pair wins. If the stock is somewhere between 105 and 110, again, they tie. Both of them in this case are worth 10 with the stock at 110. But pick any number between 105 and 110 and they will both tie. What if the stock is above 110? Pick a number. Any number above 110, and again they will both tie. So what does this show you? Well, it shows that the two options in green, the two long positions of a standard butterfly, can never be beaten by the two shorts. They might get tied, but they will never ever be beaten. And what that tells you is that the two long positions must be more valuable. In the financial world, we would say that it's a dominant portfolio. It never loses. It might get tied, but it can never lose. And so if that's true, then this pair right here, the 100-110s, the two long positions, must have more value. And those are the ones that you're buying. And because of that, you will never get a standard butterfly filled for a credit. So don't even bother trying. But more importantly, it shows that if you understand how to break down the butterfly spreads, you can figure out different ways to leg into butterflies, to leg out of butterflies. You might even be able to leg in for a credit. And would you recognize that? And in those cases, sure, why not? Do it. But it will also give you great insights into hedging, rolling, and morphing. So this is why I always like to teach traders not just the basics of the strategies, but what really makes them tick. And so, for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.